And now it's time for development debates. We dig deeper into some of the questions shaping the future and present of China. Today, we'll see experts debating if China's economy will surpass that of the U.S. by the end of this year. The word is out that China's economy might get bigger than that of the U.S. this year. It's been predicted by many indicators for years that China will surpass the U.S., but very few of them expected to come this quickly. But of course, there's a catch. It's just with one measurement tool, and it might be flawed. As Caixin reported, the International Comparison Program of the World Bank released a new prediction. It calculated GDP by purchasing power parity, also known as PPP. Based on this method, the report says that China's GDP in 2011 has reached 14.5 trillion US dollars. This number is nearly 87% that of the United States'. Using the previous figure from 2005, China's GDP will have doubled over 6 years. The most common way to calculate GDP is by using product prices in local currencies. If making a comparison between different countries, the currency and product prices will be converted to US dollars. However, exchange rates are constantly changing, so there's a margin of error determined by the rate. Using the purchasing power parity method could calculate the relative value of a product or service in different countries. This normally creates a figure that's quite different from GDP calculated using exchange rates. As the World Bank mentioned in its report, the US is still the largest economy in the world, but China is getting close to the world's #1 if calculated based on purchasing power parity. Arvind Subramanian from the Peterson Institute of International Economics said that based on data and rapid economic development in these years, China should surpass the US. That would make it the world's largest economy by the end of this year. Arvind said that between 2011 and the first quarter of this year, China will have a higher growth rate in GDP, income level, inflation rate, and currency exchange rate compared to the US. Therefore, Arvind predicts that in the year of 2014, there'll be a new country at the top of the list. However, some Chinese experts don't support Arvind's idea. A professor at the Beijing University of Aeronautics and Astronautics, Ren Ruoen, has a different take on it. Ren told China Business News that using purchasing power parity to calculate China's GDP cannot reflect the real situation. Ren said that China's rapid economic development leaves a lot of space for commodity prices to go up. Therefore, using this method will underestimate the country's price level. Ren cited data from the ICP report, showed that China's price level was only 70% of the world's average. It's only 54% if compared to the price level in the United States. The report says that China's price level is even lower than some African countries. However, Ren said that compared to other countries in the Asia-Pacific region, China has much higher prices in grain, beef, lamb, cars, and gas, along with many others. However, these prices cannot be reflected by the purchasing power parity method. Apart from that, Professor Ren said the International Comparison Program of the World Bank has adopted a new method for calculating building prices. It uses the price of construction materials to estimate the completed building prices. Ren said that between 2005 and 2011, China's huge housing price increases were far more than those for material. Therefore, Ren said, using purchasing power parity to calculate China's economy is not reflective of the real situation. No matter how you look at this figure, you can easily still make the argument that China is a large country with a lot of money and a lot of people. One big difference in the economies of the US and China is that there is more diversity in the US economy than in China's. China is reliant on housing and exports. The US has large consumption figures, which China lacks. The World Bank's report shows that in 2011, the GDP per capita in the US was a little less than 50,000 US dollars, while the number for China in 2011 was only a little higher than $10,000. That's 99th in the world. The lower incomes are a big factor in the lack of consumption in China, and it's an important variable in many predictions that say China will surpass the US. But that can also change if China's elites start wildly spending money for them.